Well, first, thank you all for coming to listen to our presentation about equity research. Dr. Brown asked that I just basically give you guys a feel for what it is that we do in equity research. We know that the bankers come out here pretty regularly, portfolio managers, private equity, but very seldomly do you hear from people in equity research. And I obviously am biased, but I think it's the best area for especially for new people getting into the world of finance to learn the business, build a very strong foundation, and figure out directionally where you want to go with your career in finance. So, and that's the title of our presentation today. Finding more than your place, but also finding your path. Okay, let's see. All right. So first, big picture. Oh, let me just give you a brief background as to my path and how I landed at Raymond James. So I went to University of South Florida there in Tampa, and Raymond James is essentially the only game in town in that area. And I was getting a finance degree and had no idea what I was going to do with this finance degree. So the firm was much smaller then. And so when I was hired in equity research on a part-time basis, because I was still going to school, it was my senior year, I landed in equity research, and we had research, sales, trading, investment, not investment banking because there was still that Chinese wall, research, sales, trading, and syndicate all on the same floor. And so it allowed me the opportunity to sit with each of these people and figure out what it is that I was best suited for. Ultimately, I decided that equity research was where my skill set and my interests lay, because the reason I liked finance was because I liked the markets. I liked how dynamic the markets were. I liked how even if you have a little daytimer or your iPhone. Actually, we didn't have iPhones in '89, but it didn't matter what was in your calendar that day. The market was going to dictate what you were going to do. So you could think that you were going to get to work and work on this initiation of coverage report, and then all of a sudden one of your companies makes this this huge acquisition. Well, it's a change of plans about face. You have to now start working on your model and integrating this acquisition into your model. See what it does to your estimates, and see what it does, more importantly, to your investment thesis, and then start making calls on that. So I liked that part of the job, being able to again not plan your day, to being surprised and by what the market had in store. But so then I started out essentially as the firm's first research associate. We only had 10 analysts at the time, and then I became an associate analyst working under a senior analyst, and then became a senior analyst covering my own sector for several years. When I moved on, I was doing business services initially, and then there became one of our analysts who was covering specialty retailing left. He went to go work for he moved to sales and trading, and so I was like, all right, well, my sector's kind of going away. He's doing specialty retailing. I love to shop, so this is a way for me to marry my true love, is shopping and stocks. And so that worked out well, because that's what got me the best on the street title in the Wall Street Journal for having the best stock pick that year among all specialty retailing analysts, and having the number 3 pick overall of all analysts that year. So doing what you love, and when you can integrate that into your career, that's a key for success, a recipe for success. So now back to our presentation, equity capital markets. So that's the umbrella that equity research falls into: sales, trading, investment banking, corporate and executive services. And this slide here tells you a little bit about what each of these groups do. So we had a small luncheon earlier, and I had them go around the room and tell me what their plans were. And when they told me what they thought they wanted to do, I said, all right, well, why did you get into finance? Why is it that you want to do this? Because it's important to know. It's important to really understand each of these jobs and each of the specific skills that are required to do these jobs well, before you go in with blinders on, saying this is for sure what I want to do. And that's why internships are so important, because hopefully when you do your internships, you're not just going and doing your one-day internship. You're going and you're meeting with different groups. So for example, Lana, I didn't introduce Lana Parker, I'm sorry, I should have done that. Lana Parker's our recruitment coordinator, and she just joined my team here recently, and one of the things she's doing is for setting up a real formal summer intern program just for equity capital markets. So she's going to make sure that someone who does an internship in equity research gets exposed to all of these different areas within equity capital markets, and then come to the realization that yes, equity research is the best. But we're going to help you get there. We want you to know what everybody else does, because they do utilize a lot of the similar skill sets, but they're not identical. And I think personality fits are better or personality types are better fits for the different groups. But it all stems with equity research in the center. We're what feeds the rest of the group. We're what determines what direction the investment banking group takes. We're what determines the trading that comes to us. It's because of the quality of research. Because obviously, Fidelity or T. Rowe Price, they can trade their stock through anybody. Why would they trade it through Raymond James? It's because they've been talking to our analyst. Our analyst was the one who gave them the idea. Our analyst has been the one that gave them, who has been working with them day in and day out to build their own models on, and teaching them about the industry and making the introductions to the executives of these companies. That's why they trade through our trading floor. So, the nucleus is equity research within equity capital markets. And I'm not just saying that because I'm an equity researcher. Even the investment bankers will admit to that. But that's why we get on deals. We don't get on deals because of who the banker is. We get on deals because the management teams want to have an analyst who is credible. Because if that analyst has the credibility, has a strong buy rating on their stock, well, that makes them that much more attractive. All right, so what do people in equity research do? Let's start with that. Well, step one, Chase, I'm going to point to him because he's here, and we just hired him. He's going to be joining us in June. Once we've hired you, then you're assigned to a sector. So you may think, oh, well, I'm a techie, I like tech, or I really like healthcare, and that's great. It's great to have a passion, and if you have some underlying skills in that space, we'll likely try to utilize that. But more often than not, we're going to put you where there's a need, where we feel like there's a personality fit, a skill set fit, and where there's a need. So you may not get thoroughly excited at the beginning, but eventually, once you realize that you will become an industry expert, because that is what we're looking to do. We're looking to develop industry expertise in whatever group you're in. So you're assigned to a sector. These are the sectors that Raymond James has. So it's transportation, industrial, consumer, energy, financial services, healthcare, real estate, tech, telecom. And then once you're in that space, you're going to be assigned to one analyst, a single analyst. And the goal is to make you interchangeable with that analyst. So people ask me, well, what does a research associate do? Well, ultimately, we want them to do everything that an analyst does. Whether it's writing the research, talking to clients, it's taking the C-suite executives on the road, everything, taking calls. That's what we want. That's what we're looking to develop. And you'll find that regardless of the sector, once you become an industry expert in it, you will. It just becomes that much more interesting to you, that much more fascinating. And in a year, you'll know more about, because you're only going to be focusing on that one sector, say 15, 20 stocks in that sector. You'll know those stocks better than anyone else, in the firm other than your analyst, including all of the institutional salespeople that we have who have been working with us for 20 years, because they have 1,100 companies that they need to know. So you're focusing on 15 or 20, so you will know those. And that's important because knowing that you know this sector will give you the confidence to go up and speak in that morning meeting at 20, 21 years old, which is what we ask our research associates to do, to be in front of that group and speak to this room of seasoned professionals, investment professionals, and make them listen to you. Let them know, hey, I know what I'm talking about here. Yeah, the stock is down 15% yesterday, but this is what the market's missing. This is when we ran our numbers, this is what the market is missing here. And you guys need to go out there and call your clients and tell them they need to be buying this stock. So building your professional network, I put that at the top because that is a big differentiator between what we do in equity research and some of the other areas. Because your name is on that research report. Once you get your licenses, your name is on that research report. The CEOs, they know who you are. They see your name every time they pull up a Raymond James research report. So when you call them, they'll take your call because they want you to be talking favorably about their company. And so this is a good way to start building your network very early on in your career, so that ultimately, if whenever you decide what your next path is, you have people to go to that can speak to your that can speak to your work ethic, can speak to your your intellect, and so that's something that you can take away with you. So the next part is becoming an industry expert. So okay, you've been assigned to I'm trying to think of a sector that's not so fun. Waste services. Who wants to be assigned to waste services, right? You visit landfills. But believe it or not, it used to be a hot sector back in the 90s. Then then all the Wall Street dropped it. Our analysts stuck with it. So now there's only like 3 analysts on the street that cover it. So we own waste. We own this space. And the research associates who we've had in it, they've loved it, because they are getting all these calls from the buy side, and they're able to get out there and talk, because there's nobody else that that has this information or this knowledge that our people have. And how do they do that? I mean, obviously it's it's company you guys probably can't even see that. Company research and modeling, comparable company analysis, which is what you guys are doing in your classes now. It's financial modeling. It's screening and tracking. Looking at different parameters. Doing a lot of sector and thematic research. I mean, that perhaps more value add than writing an initiation of coverage on a stock is writing a thematic sector piece of research. This is what we're seeing big picture. This is what's going on in the energy industry right now. This is why the next 6 months are going to be rough, but the second half of the year is where you want to be in this group. Looking big picture and making a call as opposed to making specific stock calls. That's where the clients will see the value add, and you can only do that by learning the sector and knowing it. Well, absolutely. I mean, especially in the energy sector, it's a little bit of everything. It's looking at the global picture, the political environment, and like you said, the technical expertise. Okay. Yes. We have a little bit of slide on that, but essentially we have, so on the research side, I make a call. I'm going to make a call on Ann Taylor. That was the stock I covered. Ann Taylor. So I initiate coverage on Ann Taylor in the morning meeting to the sales force. After that meeting, I'm going to call my counterpart, the analyst at Fidelity. The institutional salesperson is going to call the portfolio manager at Fidelity, and our trader is going to call the trader at Fidelity. So it's not really blurred. Now, the institutional salesperson, because they know this much about the story, just they kind of like get the client on the hook, and then when the client wants to know more, then that institutional salesperson will put the portfolio manager and say, "Oh, hold on, let you talk to the analyst." So now they can put him back to us. Make sense? Okay. Mm-hmm. Right. Yeah, we do. We have sector specialists in sales for some of our big sectors. So in financials and energy and in tech. So in those areas we do. And what's helpful about them is because we have, I think, 10 tech analysts. So for like our tech group. So whereas the sales force in general needs to know 1,100 companies, that tech specialist may need to know 200. So they're able to talk to the different analysts and know, all right, well, this guy who covers semis is saying that the distributors are, or the distributors are going to see this, and then the manufacturers over here, the hardline manufacturers are going to see this, and so he's able to kind of like weave them all in together, and then make a bigger sector call to the clients. But then ultimately, when the client says, all right, well, I want to know a little bit more, I think the place to start is to start investing in semis. Well, then he's going to put him back to the analyst, because the analyst is as deep as you go. They're the ones that are going to have the deep knowledge about a very specific group of stocks. Right, because the approach that we have in research is a supply chain approach. So we're looking at the entire supply chain within tech, or within energy, or within consumer, and we're looking at the whole supply chain, and that's what that sector specialist is able to see. So he's able to see what the entire supply chain looks like, and knows what the trends are, what the cycles are, and be able to communicate that to the client. And then if the client wants to dig a little deeper into a specific subsector, then they pass them on to the analyst. Okay. So finance and accounting. Obviously, you guys are going to be really good at that, and I say that jokingly, but I'm serious. I have told Dr. Brown this night and day difference between MSF majors and undergraduate finance majors, night and day. So I'm very excited when we get MSF grads. We've been, I don't want to say we've necessarily been targeting more, but I think more schools are starting to introduce MSF programs, and I think that's a good thing for us, or for the business, because it makes a huge difference in the caliber of people that we're getting. It seems like it's pre-screened them even further, so that the people that are in these programs really know what the job is. But nevertheless, the finance and accounting, you're going to hone those skills significantly, because our models are very, very detail oriented. I mean, I don't know the kind of models that you're building in your classes, but even more so than like investment banking. Investment banking, again, they tend to be a broader stroke. So say, for example, they're building a revenue model. They're looking at year-over-year growth, and that's or looking at if they're building an income statement and they're building a model, they're looking at maybe year-over-year trend analysis and developing revenue year-over-year growth to develop how revenues are going to look like, how margins are going to look like. Whereas in equity research, if you're building an income statement and if you're building a model, you're going to really drill down. So again, back to the retailers, what I knew, covering Abercrombie and Fitch. It wasn't just building year-over-year growth. It's looking at store count, okay, and how many of those stores are big Abercrombie versus little Abercrombie versus Hollister, because the unit economics of each of those stores are different. So we're trying to really drill down on these are the number of stores that are going to be opening, these are the number of stores that are going to be closing. This is this size store because they have two footprints. They have the large stores, they have the small stores. And again, so we're really drilling down deeply in equity research to develop those models. So that's key, I think, and again, trying to decipher or determine whether or not you want to be in equity research or investment banking is how deep do you want to go. So do the same thing for balance sheet, cash flow statements, sensitivity analysis, and regression analysis. So all that stuff that he's teaching you, it will be used. And so developing your analytical skills. It's time now to value the stock. If any of you ever interview with me, Chase will attest to this, I will ask you to pitch me on a stock. I'm going to say 80% of the people will pitch me on a company. They'll tell me why Apple, and another 80% of them will pitch me on Apple, but they'll pitch me on a company and tell me how great Apple is. And because they're going to be growing, they're going to be introducing all these new things. Well, okay, Apple is a great company, But why should I be buying the stock? The stock may reflect how great it is. It may reflect even that it's greater than it really is. So we need to drill down and do the valuation. So when you're asked to give a pitch, it's not a pitch without that valuation component. So make sure you do your valuation analysis on a stock before you prepare for any interview in equity research, portfolio management, and such. And all kinds of valuation analysis. I always tell people when I'm reviewing research at the firm, when analysts write these big initiations of coverage reports, and they do such a great job explaining the industry and explaining what's going on in the in the economy and why this sector is going to do well, and why this stock in particular is going to do well. And then 50-page report, and then at the very end there's a valuation this small, and it's like the football analogy, running the ball down the field, getting down to the 1 yard line and fumbling. The valuation part is the part about the stock. So tell us about the stock, why we need to be buying the stock, why we think it's undervalued here. And not just one way is correct. Talk about the different valuation methodologies, everything that you've taught, to tell, to make your case by whatever angle people want to, portfolio managers look at it. Because just because you may be valuing something on, PE, well, you may talk to a client who prefers discounted cash flow. So that needs to be in there. Or you may prefer a client who likes technical analysis. So even though we're fundamental analysts, it's always important to look at the charts and if you don't know how to read the charts, talk to the technical analyst and get a technical assessment of what the chart looks like. Because there's a lot of clients who will say, the chart's broken down here, I'm not stepping in. I'm not going to catch a falling knife. So, so it's important to look at every angle. All right, so now you're in your sector. You're in your sector. You've spoken to the management team. You have done the industry research and done all the analytics, and you valued the stock. Well, what do you rate it? And your choices, obviously, strong buy, market perform, sell, and then anything in between. So we have to make that. The analyst has to make those decisions. And then the research report. And you kind of have to do all this ahead of time, at least the foundation, and then so that you're able to figure out what tone, in what tone to write that research report. Are you going to be about writing it more convincingly? Yes. If it is a problem, it would reflect negatively on the analyst as opposed to on the on the executive as opposed to on the analyst or the research associate. I mean that's unacceptable. I mean I was telling stories earlier. Sometimes the analysts or the executives are not going to be happy when you turn negative on the stock, and that's why again it's important to differentiate the stock and the company. So you're not turning negative on the company. You still like the company, but you think the stock is overvalued. And the approach that most of the analysts take is, when they're trying to talk to the CEO of a company and trying to calm them down a little bit, is tell them, hey, you want me to maintain my credibility, so I need to call it like I see it. And my credibility is only as good as the quality of my work. And so this is what I think is the right thing to do. And typically it's not an issue. Don't get me wrong. Occasionally there are CEOs with egos that don't let them accept that, and it gets pretty challenging. Typically not on a conference call, though. That would not reflect well for them.
How big would the upside difference be in the valuation in order to change it from a neutral rate to higher?
We require a 15 to 20% upside for our strong buy rating.
Okay, and that doesn't change with respect to the data of the company.
No. And if it's something, obviously like lower price stocks, sometimes they might have like 75% upside. Well, if something egregious like that, we'll even have them go a step further and say, all right, that's just kind of getting a little crazy. So let's talk about why such a huge premium. You know, why is the market? Why do you think the market is missing? So we make them elaborate even further.
And are those all based on industry size, whether you have other positions on what you
No, it's all individual for for each sector, and so every analyst has different valuation methods are used depending on the industry, and and they change. They sometimes they sometimes are change when the depending on the cycle that the industry is in. So obviously, internet stocks back in the heyday, they were based on eyeballs, because a lot of these companies didn't hardly have any revenues, and so now now it's just different, still multiple sales, but still it changes. There was another hand over here. No? Okay. So again, the writing component, I can't underemphasize or overemphasize how important writing is. This is a differentiating factor between equity research and investment banking. The amount of writing that we do is a lot. So I tell people right off the bat, if you don't like writing, if it doesn't come easily to you, you will hate this job. So, but if you do enjoy writing and being able to express yourself, and it doesn't have to be dry writing. I read a lot of this stuff, and some is drier than other. I mean, I think the best research reports are those that infuse some personality into it. So we can try to spice these up as much as we can. It'd be good.
A lot of the writing
Yep. Short sentences. Yep. Yeah, that's exactly right. So he's saying it's quick turnaround. And so, you don't, I mean, sometimes you have longer periods of time when you're writing initiations of coverage report, for example, or when you're writing big thematic pieces. But when a company makes an acquisition and we've got a strong buy rating on it, and we think that the company is paying way too much money for this, and we need to downgrade the stock, well, you need to get that out quickly. You need to update your model, and you need to get this, get that note out as quickly as possible, because just like you think the company's paying too much money for it, our competitors may think the same thing, and you don't want them to beat you to the, to the street, to getting their note out. Oh. Good question. We, in Raymond James, what we do is when you first start, you're assigned to a sector for 2 years. And we say 2 years because that initial first year is tough. You're not just learning your industry and your stocks, you're learning the industry, the financial services, equity research industry. You're learning the technology that we use. You're learning the processes. You're learning you're meeting the people within the department. You're learning the job. So and you're getting all your licenses that are required for this job. So that first year is tough. We always say your first year you're not adding a whole lot of value to your team. It's in that second year where our investment we start recouping our return on our investment. So so then after year 2 is when we if you want to switch sectors, we allow you to do that. And I was telling the group earlier that maybe only 20% of the people take me up on that. And I think a big part of it is because they remember that first year. They remember how hard it was, and they think it's going to be just as hard, but it's not. Everybody who has transitioned to a new sector, I've yet to have anybody tell me it was a mistake. Everyone is glad that they did, because they learned a new sector. And it could be something tangential, or it could be something totally different. But if the long-term goal is to move to the buy side, which for some people it is, then covering multiple sectors makes sense. It's only going to make you that much more marketable. If, however, you get placed in real estate and you decide, I love real estate, and I'm not even as interested in all this finance stuff. I really like real estate. And you think that ultimately you may end up, going into, corporate real estate, well then, you stay in real estate. So that makes the most sense. So it's very, I view this, the research associate job, as just a place for you to figure it out what it is that you want to do. Because, I know a lot of you say this is what you want to do, or you know what you want to do, but you really don't until you're in it, until you're actually doing it. But you're still way far ahead than I was when I was in your place, because I had no idea what anybody in this business did. So here's how it all works. So back to your question back there about the sell side versus the buy side. It's probably the biggest question I get all the time is, what is the difference? So we're selling it. We're selling our ideas, the research, equity capital markets. We're selling it to the buy side, the portfolio managers of the world, the big money managers. So equity research, I have the little light thing, right? So equity research over there says, I recommend our clients buy Apple, the analyst does. And he's saying it, in front of the morning meeting. So then the institutional salesperson says, our analyst thinks you should buy Apple, and he's calling the portfolio manager. Portfolio manager agrees, I think Apple looks cheap. So then he tells that to the institutional salesperson. The salesperson calls the trader and says, hey, Fidelity wants to buy 1,000 shares of Apple. So the trader says, I have 1,000 shares of Apple to buy, now I need to find a seller. So that's their job, to match buyers and sellers. So that's how it works. I've kind of oversimplified it here by putting the portfolio manager as the only person on the buy side, whereas in reality, the analyst has our counterpart over here and the trader has his counterpart over here. So that's the sell side versus the buy side. Oh, I thought that's my next slide. So some of the key differences, sell side, buy side. Again, we are the service provider, the buy side is the client. We are the industry expert. We focus on one industry, cover 15 to 20 stocks. They tend to be generalists and cover multiple sectors. So that's why they call us. That's why they're looking at our industry expertise. And we tell them we think something is a buy, but they'll make their own investment decision. They'll talk to us and they'll talk to some of our competitors, and then they'll get all that information and see what makes sense for them, and and then ultimately make their own buy, sell, hold decision. We do deep dive primary research. So whether it's surveys, channel checks, that's what we're doing on our side. And they're relying a lot on the sell side for our research, as well as some that they do some of forensic research that they may do on their own as well. We develop strong relationships with the C-suite executives with our client companies, and they develop relationships too, especially if it's a huge position. But it's not as long term, so consequently it's not as deep. And we make the stock recommendations, but they're actually pulling the trigger. So when they agree that they're going to buy something, they're going to put hundreds of millions of dollars into it. So it's they're pulling the trigger, and their neck is on the line. Oh. Right, and you're talking about regulation, full disclosure, that with the management teams, it's a lot less than we used to be able to have. But again, there's something to be said with that long-term relationship that we've had with. Sorry, I woke up with this cold yesterday, with this cough. It's not so much what they say, but it's how they say it, or how they've said it in the past. When that analysts start to be able to read the body language. Okay, sorry. But what the C-suite executives, so those conversations tend to be more big picture. What is going on in the industry? What are some of the trends? I knew this was going to happen. And then trying to, and having similar calls with the rest of the management teams, other companies, and then trying to figure out if there were any big themes. Yeah, that's exactly it. That's the deep dive. But when, on the calls, you'll hear, the management teams will give you guidance. They'll give you the guidance as to, what their expectations are, for the upcoming quarter. All right, so you have that guidance. You start plugging that into your model, and it doesn't add up. Then you can call the management team and say, all right, this is what you said on the call, but that doesn't add up. How, what am I missing here? What didn't we include here? So those kinds of conversations, you can kind of just drill down a little bit more based on those conversations. That they can do. That's allowed. As long as that bottom line guidance number doesn't change on that call, that's allowed. Correct. All right. Equity research jobs are highly competitive. So how do you differentiate yourself? And this is just purely Mercedes talking here. This is what I'm looking at when when I have 500 resumes to sift through. I want majors in finance, accounting, or MSF. Because as that old saying goes, if you do what you love, you never work a day in your life. I'm looking for somebody who has a passion for the markets, who knows what's going on in the markets, who's reading the Wall Street Journal or watching CNBC. And you can put that into additional items like books that you've read or fantasy portfolio trade tracking that you do, or maybe you're writing for Seeking Alpha. All these things that you can be doing that demonstrate an active interest in the markets. Securing market-related internships, and by doing that, you're learning the jargon because there's a lot of jargon in this industry. Joining finance clubs, Smiths. Talked about the fantasy portfolio. Embarking on the CFA program. Even just starting level one is a. We know you are committed to this industry if you're crazy enough to do the CFA. So that is huge. That shows a real level of commitment to this group. Some new grads have already taken some of these financial modeling courses, like Wall Street Prep and Training the Street. A lot of universities have them come. They offer them here at the schools, so they have that already on their resume. And then again, write. That is the one thing that we have. We have a hard time. Well, we used to have a harder time figuring out who can write based just on your grades. So what we do now is when we bring you in to do your super day at Raymond James, included in one of the you interview with several different analysts, but then you also have a time slot where you're given a writing assignment. This last semester, for example, the assignment was should a college education be free? We all have you should have an opinion one way or the other. I don't really care what your opinion is, but I want to see how you express it. And you've got 30 minutes to write about it. Other questions that we've asked in our energy group, we've just said, oil's here, why? What do you think is contributing to oil being at sub $30? Those kinds of questions. And then the research associate program, again, this is kind of sums up what it is that our research associates do. They work closely with the analysts. It's one-to-one. So you and your analyst, typically, sometimes it's 2 research associates to 1 analyst. So it's very small industry groups, which gives you a lot of responsibility and visibility very early on. So when we're interviewing, yeah, I'm looking for the grades. Yeah, I'm looking for the passion. But I'm also looking for that person who is well-rounded. So we're going to be putting you in front of our clients. We want to make sure that you can hold your own and you can carry yourself and you show well. So I think in a lot of industries, research people are the nerds that sit behind a computer and lack in social skills. We can't have that. We need you to be extroverts because you are out there talking to clients. It's as much of a selling job as it is an analytical job. So we need outgoing people and confident people who can go out and and address a room full of seasoned executives and pitch them on a stock. And we do offer we sponsor the CFA program because we don't mandate it, because again, we think this is you guys figuring out whether or not you want to be in this industry. So we don't mandate the CFA, but if you want to do the CFA, we sponsor it. And we ask for a 2-year commitment when you're hired. These are the skills that you hone while being in equity research. Again, a lot of that is pretty much the same stuff we've already discussed. So a day in the life. It's always a popular question as well. A day in the life of a research associate. Big difference between us and investment banking here. We start way earlier. They work way later. So our research associates, this is Eastern time, are in between 6:30 and 7 o'clock in the morning, because our research meeting is at 7:20. So the newer you are, the earlier you need to be there. Because if news hits the tape, it's going to take you longer to go through it and decipher whether or not, how this is going to impact your stocks today. And then if it's going to be a big effect, then you're going to need to put something together and write a note before that 7:20 meeting. And then, so I mentioned the 7:20 meeting. After the meeting's over, you come back and you prioritize your tasks. You can spend the day writing, you can spend the day modeling, you can spend the day on the phone if the stock is blowing up. You could be out on the road, taking management teams around. You can be attending conferences. So there is no normal day in this business. Yes. First year, not so much. Really, we try to do it just if we're in a pinch. So I'm going to say, maybe 5% first year. Second year, maybe 15. After second year, you become a senior research associate. So at that point, the sales force feels comfortable putting clients on the phone with you, and obviously, and then having you meet with clients. So at that point, it could be as much as 20, 25% for some of our better research associates. Okay, and then 6 to 7 o'clock on during non-earning season is typically you're at the end of the day. That's not to say that, well, I shouldn't say that. That's when you leave the office. All research associates have their work email on their phones, and you're expected to check it throughout. And your analyst will call you throughout the evening if necessary. If you submit something, if you submit a note, whatever, at 5:30, and you go home, you need to track it throughout the night to make sure that there was no issues with it in the publishing, once it reaches publishing, until, so you see it through to fruition, until it is released. And that could be 15 minutes later. It could be 6 hours later. So it's up to you to stay on top of that. So it's long. It's long hours, and that's, goes back to what I say. If you love what you do, you never work a day in your life. And that's why, the passion for this business is important, because otherwise, if you don't have that, you will burn out. But I've been doing it for 27 years, so it's possible. All right, so after that, you've been in research. You've been here. Our average research associates will stay with us 3 years. Some leave after a couple years. We've had some that have been here with us for 10 years. They like the job. They are inflexible. Those that have been here like 10 years don't really want to be an analyst because of the level of responsibility. It's a heightened level of responsibility. But they're not flexible. They're geographically tied, to the area. So if you're in Florida, then Raymond James is the only game in town. So there are different reasons why some of our research associates have been there longer than others. But whatever the case, we'll keep them because we've developed this industry expertise, and it still benefits us, and they're happy, and we're happy. But for the most part, research associates will stick with us on average 3 years. They either go to the buy side, and we work with them on that. If they come to me and say, this is my goal, I want to do 3 years here, and they go to the buy side, I've got relationships, and our sales force has relationships with a lot of clients. They know that we turn out good research, that we turn out good qualified investment professionals. So, T. Rowe Price, the director of research at T. Rowe Price, calls me and says, I need somebody in healthcare. do you have anybody who's ready to move on? And we send them some of our senior people, because we'd rather our research associates go on to be clients of ours than to go on to be competitors of ours, because we know how good we've trained them. Top tier business schools. That's the other option. This year we're losing 2 of our research associates because they're going back to business school. Used to be, I would say, it used to be 80% of our research associates would go off to get their MBA. It's far less than that now. But I think a lot of it is because of these MSF programs now. It's not as necessary. And plus the ROI has gotten not so attractive anymore. Industry, they come into the job and realize that, you know, it's not really the finance part of it and the markets part of it that I love. It's actually the sector that I'm covering that I love. So we've had, you know, our research associates go off into industry, in the energy industry, in the real estate industry, in the healthcare industry. I don't know if you guys know, Bilal Yahia just left us on Friday. He went to go work with one of our client companies, and he was one of you a couple years ago, and he killed it. He killed it. He was awesome. And he accepted a position to start the investor relations group for a company based in South Florida. So in addition to building the investor relations group, he was also going to work with them on business development. He is very attractive to MENNAX because not only does he know MENNAX very well, but he knows MENNAX's competitors very well. So that is a huge part, you know, a huge benefit. And his role in investor relations is ideal because his clients are going to be research analysts. So that's who he's going to be dealing with, people like himself when he was at Raymond James. So he knows what it is that they're looking for. And then about 30% of our research, of our analysts, the current analysts, started out as research associates. So that is yet another path. We always say it's not a guarantee because we can't promote everyone to be an analyst, otherwise we'd be very top heavy. But there is that possibility, there is that path for those who seek that route, who want to stay on the sales side. I'm really going to go into all of this, but this is just for you guys when you want to see just who Raymond James is and where we stack up in terms of equity research. These are by number of companies that we cover. This slide typically surprises people. Raymond James is third only after Stifel and RBC in terms of the number of companies that we cover. So, yes, Meg?
Sorry, this is going to back but you don't have to.
Yeah, because I don't know how.
Other 70% of that balance were with other companies like Woerkom, or?
Yeah, typically I've been there a long time, so I've been through 3 directors of research. So it depends on the director of research. The director of research that we have now, he tends to hire more from established sell-side analysts. So yes, he's getting them from our competitors. His predecessor used to get them more from industry. So we got our head of our healthcare team came from the healthcare industry. Our head of our telecom team came from the telecom industry, and then his predecessor actually used to groom them. He used to build them up. So he'd hire them fresh out of good MBA programs and develop them. These are where we have just equity research offices, so not Raymond James in its entirety. This is just equity research. So these are the different areas. Some information on our summer internship program and what what our requirements are. Recent accolades, again, and taking your next step. Yes.
Question. The industries prefer students understand how job work, performance evaluation. What is the performance evaluation?
For a research associate fresh out of school? Okay. So for a research associate fresh out of school, your first year, your performance evaluation, we're going to make sure that your licenses, you got to knock those out. So it's your Series 7, your 86, and your 87. In addition to that, at Raymond James, we also require first-year research associates to do a research project. And that is to essentially write a research report from start to finish all by themselves. And so but it's not an exercise in futility. This is something that we want published. So you get with your analyst at the onset to identify a company that he wants to pick up coverage of, and then you go and visit that management team with your analyst. After you visit that management team, then the rest of it is you're on your own. So we want to, and again, we don't want you to reinvent the wheel. So if your analyst wants coverage of this company picked up, then use his template model, the template that he usually does for his research reports or for his models. Use that same format. But we want to see your thoughts on how you weave together your investment conclusion, how you build your model. If there is, we want your spin on what he would have the research report that he would want you to do. And then after it's all done, then you would present it to management of the equity research department. Because it gives us an opportunity, it does two things, well, it does three things. First and foremost, you'll find, every research associate that has gone through this, it's a huge confidence booster, confidence builder. Once you do something from start to finish, you will learn this project. You're able to connect the dots. You see how everything fits together. And from that point forward, you'll understand why your analyst is asking you to do this and do that and that. So it's a huge confidence builder because you will know that company better than anyone. You'll know that company better than your analyst because you did all the work on it. And secondly, it gives management an opportunity for us to see, to see your salesmanship, because you're going to be presenting it to us. So it gives us the opportunity to see who the potential stars are. So that's so back to the performance evaluation. So we make sure your RA project is done, and we discuss that. And then essentially it's just where they are on the learning curve. Depending on how technical the industry is, we usually say it takes anywhere from 6 to 9 months. If it's not very technical, it takes about a year to get up the learning curve if it is a very technical industry. So we want to see where you are learning curve wise. And so that's your first year. And again, then you're only doing what you're told, what your analyst is telling you to do. But by the second and third year, we want you to start pushing ideas to them. So over the weekend, you were reading a trade journal and you saw this story on, on X, and you're able to tie it back to, something that you wrote about in this initiation of report that you did, your RA project. And say, I think we need to write a follow-up note here because, we can say how we think this supports our investment thesis. So you pushing the information more to them. And then, of course, talking to clients. When you become a senior research associate, it's usually after second year, there's an added component, which is Salesforce evaluation. So again, now the Salesforce is saying, and we have the Salesforce grade you on knowledge of your sector, knowledge of stocks and markets, long-term analyst potential, helpfulness, and a couple other things. And so the Salesforce is saying, because now they're talking to you just as much as they're talking to the analyst. So they're talking to you and they're putting clients on the phone with you. So how comfortable they are doing that. So that comes into the performance evaluation as well. Licenses and yeah. Correct. Exactly. Yep. And arguably, every single time there is an opportunity for an associate to move into an analyst position, the first thing the director of research does is asks me, where do they rank on the Salesforce evaluation? So again, it goes back to not just being, a bookworm and introvert and getting comfy, settling in comfortably behind, in your cube. In order to do well with that Salesforce, you got to put yourself out there. You got to be visible. Yes. Every service has different metrics. So StarMind, for example, does earnings estimates, earnings accuracy, and also just stock picking, where you just where the stock was when you recommended it, where it was when you downgraded it. So that's typically, you know, the main way that it's evaluated, looking at your entire sector. Did you rate them properly? Some even include a total return perspective in there to see overall who had the best picks, so it varies. I think the one in the Wall Street Journal, the one where I was named, that is pure just stock performance, so not necessarily, you know, no earnings accuracy. It's just how the stocks performed without any reflection of dividends. Yeah. Yeah, I mean, you know, everyone's human. And, you know, the longer you're covering a sector, the longer you have these relationships with these CEOs, you like some more than others. I mean, it's just like, you know, each other, you guys here. You like some more than the others. But there is that added component. You know, one of the other jobs that I don't think I mentioned to you guys that I have is as a senior supervisory analyst, I review the research and sign off on it. And from a regulatory perspective, so I'm a Series 16 licensed person, and so I have to read it, make sure that what they're saying in the note matches, is consistent with their rating. So sometimes they're writing all these things, you know, the outlook for the future, the margins are contracting, we're cutting our numbers, we're cutting our target price, but we're maintaining our strong buy rating because we think this is a great company. So I'll go back to the analyst and say, wait a minute, this doesn't match. You know, the stock's already down 20%. You still think there's more downside risk than upside potential to your numbers. Why are we keeping a strong buy rating on it? I will never tell them they need to change their rating. I will challenge them, and if they really think it still needs to be a buy one, I will tell them, okay, that needs to be rewritten, because right now it doesn't make any sense. It's not fluid. So so there is like a stopgap there. So if an analyst is maybe torn, or it's harder for them to downgrade the stock because they like this management team, you know, then the supervisory analyst will hopefully be able to see between there and tell them, all right, you know, we need to take a step back and revisit this. Banking, there's not a deal they don't like. So all bankers love all deals. But that's where research, you know, you have to be able to walk away, because ultimately the bankers will do a deal and they're done with it. They walk away. Research on that same deal, we pick up coverage of it, and it stays with us. We're covering it for the next 5-10 years. So if it's a dog and you put clients in it, that's your reputation, and that's going to follow you for a long time. That dog has a long tail. I personally have not. The analyst that I trained under did, and he's a real rebel rouser. But he not, when we hired him, he was covering the furniture retailers and manufacturers, and I was hired to work with him. Or when he wanted his own research associate, so I went to work with him. And not only did he initiate with a 4, but it was his first stock out of the box that he initiated while he was at Raymond James, and he came out with a 4. And it didn't work out so well. The stock didn't work out so well, and the call didn't work out so well. He was right on the fundamentals. What he said was going to happen with the company from a fundamental perspective was right, but the stock continued to move higher. Mm-hmm. Oh, it's tough. I mean, I mentioned Abercrombie and Fitch. I was so wrong on that stock the entire time I covered it. I was right on the company. People weren't willing to pay as much for it, but they just had such a cult following amongst portfolio managers that regardless, I mean, they missed every quarter for like 4 consecutive times. They kept missing quarters. So I would be right fundamentally, but they, you know, but my stock performance would still stink on that one.
How is it possible to have this the start of pricing stock without having a
Well, I mean, that's a good point. I mean, the market obviously is made up of several different components. You're covering one specific sector. So we do have in our real estate group, for example, we have, they have sector weightings or sector ratings. And within that sector is how they base their investment ratings. So we do. And yeah, again, so within that specific sector, they love that. And our sales force loves pair trades and recommendations. Then we get both sides.
Thank you very much.
Well, thank you all.